listed on the screen. Please say thank you to these companies as you enjoy our hybrid Denver Startup Week. And don't forget to use hashtag Den Startup Week to share your experience and moments of inspiration on social media. Have a great week.
Welcome to this session of Denver Startup Week. I'm Serene Papenfuss, a principal at Kickstart Fund. We're on a mission to build great companies in the Wild West by backing the boldest entrepreneurs with capital, community, and expertise for the journey. A lot of VCs happen to invest in Colorado. At Kickstart, we focus on it.
Years ago in the Denver community, based off of working at agencies and loving the pro bono work, and figured out that I can make money at designing for social impact and nonprofits. And really, in the 17, 18 years I've been doing that, really was frustrated that change wasn't happening fast enough. And so Causeworthy was founded in 2020. I came here to the Commons and went through the Co-Starters program and began a journey on creating accelerators for nonprofits to be part of, to ideate and take risk without the constraints of grant funding, and really think about how they could serve their constituents and who they provide for in a different way. And so I too help consult with them and help them find diversified funding. And so today we have an amazing panel kind of to show you all the different types of funding opportunities out there. And so without further ado, I'll let the panel introduce themselves. If everyone can kind of let you go down the line, share what company you work for and the types of funding that you offer, and a little bit about maybe a specific story on funding that's interesting, something that maybe was unexpected.
Hi, my name's Stefanie Fox, and I'm with Colorado Enterprise Fund. I've been with the company for 3 years as a lending officer. Colorado Enterprise Fund itself has been here in Colorado making impact to small business since 1976. So this year we're celebrating 45 years. And our mission is really simple. It's to make that there shouldn't be no barrier to an entrepreneur or small business owner in regards to capital. So we want to provide capital for businesses to start and to grow. And along with funding, what makes us unique, because we are a nonprofit lending institution, we're not a bank, we offer coaching and mentoring for all of our borrowers. And we can do that pre-loan. Most of that assistance comes after the loan's closed. We offer term loans and lines of credit, and could talk a little bit more about programs later. And we have lots of capital right now. So look forward to sharing more about what role we play. And these are amazing community partners that I work with entrepreneurs to get them funded.
Hi, everyone. My name is Snyder. I'm with Denver's Office of Economic Development and Opportunity, also known as DEDO for short. I've been with DEDO for over 30 years. I am the manager of the Small Business Loan Program. And prior to that, I spent 8 years in commercial banking as a commercial lender. Just to give you an idea of some of the projects that DEDO does, we did a very interesting project with one of the entrepreneurs sitting to my right, Victoria Brunner, who owns FattE-Bikes. It's an electric bike company. And so we did a loan with her, and our portfolio is very diverse. We've done craft breweries, craft distilleries, we've done restaurants, neighborhood grocery stores, bakeries, the list goes on and on. So that's a little bit about DEDO. Oh, let me just say that we've been in existence since 1986. Our lending boundary is the city and county of Denver only. We have done probably close to 1,000 loans during that 35 years, and we've revolved over $180 million since that time.
Oh, absolutely. Yeah. Sorry. Thank you.
Thanks so much. I'm Serene Papenfuss. Hopefully this is on. I'm at Kickstart Fund. We're based in Salt Lake, but we are the most active tech VC in the Mountain West, so primarily invest out of Utah and Colorado. I come from a growth equity and management consulting background and came into seed stage investing in the last year. Let's see, Kickstart was founded more than a dozen years ago. We've invested in more than 130 portfolio companies. We are industry agnostic, so I've done everything from, SaaS, marketplace, data, et cetera. And we're investing out of our fifth fund, which is 110 million. I come from a B2B SaaS and marketplace background, so that's mostly what I invest in, but look in adjacencies like consumer and fintech as well. And we love our Colorado portfolio companies. We've invested in everything from consumer marketplaces like Sondermind and Havenly to my last investment was CareCar about a month ago, which is also out of Colorado, an EMT marketplace. So I don't have a particular story to share, but I'm sure those will crop up today.
Exactly. And she's being really kind, but they're also a sponsor of Denver Startup Week, so we thank them.
Well, Rick did my intro for me, but I am Victoria. I am one of the co-owners of FattE-Bikes. There's actually a bike behind sitting in the back there. And we're actually in our fifth year. We are Denver's first electric bike brand and one of the only companies in the entire country to actually custom build our bikes from the ground up. And I would say an interesting story with funding is that it has been a maze over the years, and there is it's really finding your way through that jungle of different ways to get lending. There's so many different options, and finding what's best for you and what stage of your development and who's really going to be interested in you are all, if I could give one piece of advice, it's one word, and that's patience, because it's not easy and it's almost its own full-time job. So yeah, that's kind of it in a nutshell.
I think we got that. Yeah. Sound good. Josh Peebles. I'm the director of commercial banking for Collegiate Peaks Bank. We're about a $650 million community bank. We fund various startups from distilleries, breweries, retail, restaurants, you name it. So we've got, probably a pretty decent laundry list of success stories. So.
Thank you. So, in terms of most folks here are probably in their early stages, so we'll probably focus some of our energy in that direction. But of course, we'd love for our panelists to share kind of all stages of the funding cycle. Maybe starting with Kickstart, since you're in that seed funding, if we can pass it around on the panel, but talk about sort of the examples of companies that are best suited for your funding structure.
Yeah. Do you want me to talk end to end or just what we do?
Sure. Cool.
Yeah, it's helpful to know the big picture, I suppose. So at the very beginning, you're typically looking for pre-seed or seed capital all the way to the, and there's no really end technically unless you want to exit your own, yourself out of the company. But the exit that a lot of people dream of is IPO or exiting to a strategic or, a private equity firm. So we're in that very early stage part of that, helping people, get out of their garage or get with a co-founder in their garage or whatever it is. So our bread and butter is seed. Our name actually used to be Kickstart Seed Fund, and we were rebranded since we do pre-seed, seed as well as Series A. And the Series A and beyond tends to be follow-on, but we're typically helping founders, during that stage of identifying product market fit, and just, getting up off the ground to go to market.
Thank you.
Yeah.
And so I was wondering if maybe Stefanie, you or Rick can kind of talk about sort of that next stage funding, kind of after seed, and the sort of debt financing and sort of where CDFIs begin.
Sure. You want to go?
I'll go first.
Okay.
So Dito is primarily interested in small business startups and small business expansions. So I would say that 70% of our portfolio are startups and the other 30% are expansions. So we're really looking to fund those businesses that are what we call unbankable, that there's something in their application or their request, they don't meet certain ratios, they may not have enough collateral for a traditional lender like a bank. So those are the kind of projects that we're looking at that typically we deem unbankable. In fact, our money comes from U.S. Department of Housing and Urban Development, and their mandate to us is to provide access to capital to those small businesses that can't go through traditional lenders and acquire funding.
And similar to Dido, CEF is, our footprint is just bigger. So we're lending all over the state of Colorado, similar to those unbankable. So most of our borrowers will come to us because their bank said no, or they can't get funding elsewhere. And our funds can be used everything from starting up your business to equipment purchases, vehicle, commercial real estate. We offer lines of credit, which are great for businesses that operate on contracts and need to have payroll. So the lines of credit fit that borrower specifically. So yes, same thing. A lot of our funds come from the CDFI fund, which is a division of the US Treasury, and we're also grant funded. So we have access to that capital, and they want us to lend to the borrowers that have been denied that. And we have specific mission-driven points that we want to make. So veteran-owned businesses, Black-owned businesses, low-income borrowers that meet a certain threshold. So those are our mission boxes that we do want to meet, but we lend to all types of borrowers.
I turn it to you then, Josh, to speak to sort of the
Yeah.
traditional bank.
So obviously the word unbankable has come around here. Really, there's some kind of misconceptions on banking and whatnot, but to become bankable, kind of from regulatory practice and things like that, we have to demonstrate a cash flow stream and a collateral source. And so if there's like a partner with outside collateral, so it can be, a brand new startup, no problem, as long as some of the partners have some outside cash flow that can help kind of support the debt. So we can start, really early stage if there's, like I said, an asset, and we can also do SBA lending for lack of collateral all the way to, fully funded, mature businesses as well. So.
Thank you. And Victoria, do you want to share with us sort of where you began in your funding journey and sort of where you are now?
Sure. So the first couple of years are not easy for any business to start up, and funding is obviously the biggest thing that you're thinking about as you're getting going. And I would say the first year, we really were only funded. We had a partner, a friend of ours, who came in as part of the business, and he kind of funded us as the seed money or pre-seed money, however you want to put that. And then it really came down to friends and family that first year of getting and raising money from them, because we were an interesting company in that we're an electric bike company. There's a lot of supplies. We had to put a lot of upfront money for our overseas supply chains, but a lot of lenders really wanted nothing to do with us because we didn't have any traction. So I'd say the first year was the toughest because we did have to go to a lot of friends and family. And then that second year is kind of when I believe Rick came into the picture, and we started that process with the city of Denver. And I don't know if you wanted me to talk about that now or later.
Yeah, that'd be great.
Well, it was interesting because we were kind of one of those companies that was unbankable, or we had exhausted all the traditional avenues. And I'm not sure how we came across how Rick and I got connected. But, we started that process. We found out about this, somebody had told us the city of Denver alone, that they work with, startups in the city of Denver. They're trying to support companies like you guys. And so it was an interesting process because I would say Rick warned me from the very beginning. He's like, this is not going to be fast. So that's another key point I want to emphasize. When you're going after these loans, it's not a fast process. If you're like, I need money now, well, guess what? Hurry up and wait, because for us in the process with the city, at least, it was about 5 months from the time we started talking to the time we actually got funded. And that's not always going to be the case with a lot of loans. It'll be a faster process, but all of them are going to ask you to have all your ducks in a row. They're going to ask you for tons of different papers. Then they're going to come back. You're going to submit all this stuff, and then they're going to say, okay, that's great. Now we need all this stuff. And it's just like several rounds before you even get them in the processing mode of seeing whether you're approved or not. And that can be weeks. So again, but we were just so appreciative. And I think they were kind of one of the loans that really helped lift us into the next phase of our growth. And so really without them, I don't know that we could have gone as far as we have now.
And my next question, I'd love to start with you, is what, on catalyzing on that initial funding, was that what made your company the most attractive, or what would you say were the kind of key components of attracting the funding going forward from there?
I don't know that it attracted more funding at that right away. I think it's been more like it just helped us really secure our supply chains, and then we were able to increase sales, bring on more people, and then about a year later, we were able to get some more funding from that. But our most of our funding has been primarily debt and not investors. We've had a couple small investors, but primarily loans.
Makes sense. Josh, do you want to talk about what makes a candidate attractive to your bank and your particular funding
Yeah,
strategies?
totally. Yeah, so on the banking world, from a regulator side, we always have to have a proof of cash flow. So you could be a seed stage that wants to start a brand new business. You could be somebody that's been operating for 5 years and have that built up through your business entity already. And so really for us, we offer equipment lines of credit, SBA financing, revolving lines of credit to float accounts receivable, things like that. So we just need to figure out, what the goal is, what the need is, and then be able to see what the source of repayment is, because banks can't really go off of projections. We have to have some sort of kind of backstop from a regulatory level. So.
Thank you. And for the panelists sitting to my right here, for those early stages, what would you say are sort of the considerations that you're looking at, or what kind of is the attraction for you? Anyone? Popcorn style.
So for Dito, we take a much different approach than, say, a bank would. We have to, because we're looking primarily at startups, and that is our primary objective, is to provide access to capital. So what we're looking at that is different from a bank is, I'm looking for a real solid business model and business plan. We are also concerned about cash flow. So your projections, well, it goes without saying, if you're a startup, you don't have any historical financial information. So we're going to look really hard at your projections. So they have to be reasonable. They have to prove to us that the project can cash flow and service all the debt that's out there. So that's what we're looking at, is a real strong business, business model and business plan.
Thank you.
Do you mind if I tack on a little bit?
Of course.
Yeah, so from the banking side, on the startup level, it's just as Rick said, really good business plan, somebody with experience in the business. If you worked in, one industry and you're trying something else and you wanted to go do that, we're going to look for somebody that has experience, key management, ownership, things like that. On the projection side, we're going to look at, all right, does this sound reasonable? And I'm just going to use a restaurant for an easy one. If number of table turns per hour, average ticket prices, things like that. That's some real thought and process went into that. And then kind of the primary sources and uses of funds. So what you're proposing is debt and equity, and what you're proposing to use it for. So.
I'd like to just add on to what Josh said, is that, yeah, we're looking for somebody that's been in the field before, that they want to enter. Clearly, you don't want, what we see a lot of is people that have worked in the restaurant industry, but have really never owned a business or operated a business. And there is a huge difference between working as a server or in the head of, or the front of the house, as opposed to just actually being the owner and operator of a business. So we're going to look to see if you have deep experience in that field.
Since COVID, CEF has taken a little bit of different approach to startups. So while we want to look at a very solid business plan and projections that are well thought out with assumptions, we won't use that for cash flow. Something I didn't mention in the beginning. So we're a micro lender. Our average loan is about $35,000. we'll lend from $1 to $1 million, but that little sweet spot, 35 to 50. So if someone's coming to us and they're, let's say, a home-based business and they want 10 to 15,000, that's going to be a little bit different in terms of cash flow, because most likely there is outside income that we can use. Someone in the household will help. Maybe there's still a job during the day. So we are going to look more at what the definite sources of income are. We're not just going to go off the projections.
Thank you. Do you want to add anything?
I think at the end of the day, a lot of what we're looking for, whether it's debt or venture capital, is going to be pretty similar. I mean, to give you an idea of what's going on under the hood as a VC, when I'm looking at a deal, I create a snapshot and I have like a heat map, that's what I call it, where I have these different qualitative and quantitative factors of what I'm looking for and how this business ranks versus other deals that are in the pipeline. So qualitative factors, like was mentioned, are like team quality. So how do I feel about this person's ability to sell? Like they have to be the best salesperson in the company. They have to sell, potential employees, prospects, other VCs. Do I feel confident in their ability to raise at the series A, B, C? If I don't, why would I invest in this person? Other qualitative factors like the business model, is it scalable? Quantitative factors like gross margin, sales efficiency, retention, et cetera. And if they don't have an attractive profile from a quantitative perspective, what data points give me confidence that those things will improve? So to give you an idea, I'm looking at an investment right now. And when the founder pitched me, the gross margins looked like 5%. Like that's not good compared to the average marketplace business that I'm generally investing in. But we had a long talk of like, okay, why is that? Why do you have a COGS skew? What's going on there? What gives me confidence that you're going to scale it to, the 40% that you're pitching? So being able to story tell why you think you're going to get to where you're going to get is so critical. And that's so much of what venture capital is just, it's a storytelling industry, right? I think something else I wanted to tack on as well is what's interesting about Kickstart and some other VCs is that we have many portfolio companies. I think a lot of people think about, okay, I can raise from venture capital, I can raise from debt facilities, or I can bootstrap, and it's mutually exclusive. And that's not necessarily the case. We have portfolio companies that have raised from us and have used us as a signal in raising from debt. And in some cases, I and multiple members of our team have told founders, hey, we could you can raise more capital from us, but it really doesn't make sense for you to give up more shares of your company. Like, we are happy that we invested in you, but you should, whether it's an accounts receivable issue or, an inventory issue because, you're a consumer hardware business, whatever it is, in some cases, we will recommend we can give you more funding, but it is better for you as a founder to go raise debt and use us as a signal, a positive signal. So in some cases, we have founders that raise from both, and that works best for them. And so the thing I'm trying to tell is that they don't have to be mutually exclusive options, and you really want to focus on finding someone, whoever you raise from, that is founder friendly, that's going to give you the right advice for you.
And one quick question for you, your VC firm is based in Salt Lake City. So tell us a little bit of what attracts your firm to the Denver, entrepreneurial ecosystem.
Yeah, it's a good question. I think of Denver and Salt Lake and, the Boulder area too, as very much sister cities. I think there's a very similar vibe. I've, worked with founders from across the country, and it's definitely a unique feel that you see in Utah and Colorado versus elsewhere. I think you tend to see, more hustlers, a lot more humility, I'm just going to say it, versus, Bay Area and New York founders on average. And I think that we have something special going on in terms of like an ecosystem that's been burgeoning. And I mean, everyone knows this, but like building here is so much cheaper, but you're still going to find extremely quality entrepreneurship. And I think, based on the last few years of especially Denver setting records in terms of how much has been raised per quarter, has just, raised flags of like, this is a fantastic place to build. And we have portfolio companies to show that. So like the more money that's coming in and the more quality entrepreneurship that's coming out just keeps this virtuous cycle going. And we want to be part of that virtuous cycle.
Wonderful, thanks. So Rick, you've been with the city for over 30 years, so thank you for that. One of the questions I want to ask the entire panel, but I'd love to start with you, is what changes and opportunities have you seen in funding in that time with the city?
Not much has changed. The program has been virtually the same since when I walked through the doors in 1991. We basically offer what's called gap financing. And what that means is that we typically task our borrowers that come to us, go out and raise as much private capital as you can. And if you can't meet the total of your capital stack and you have a gap, that's when you come to us and we look to fill that gap. We have two flagship loan programs. One's called the Revolving Loan Fund Program, RLF for short, and we have another one called the NBR, Neighborhood Business Revitalization Loan Program. So these are the only two loan programs we've offered, or at least that I manage. There are several others that I won't get into. There's a HUD Section 108 that's I won't bore you with, but the two main flagship programs are the RLF and the NBR. The RLF program allows us to finance up to 30% of your total project costs if you're a female-owned or minority-owned business. Otherwise, it's 25% gap financing, or whatever the demonstrated gap is, whichever is less. So let's say you have a $100,000 capital stack that you're trying to achieve. You go out, you raise as much as you can, and you stop at 75%. You need 25,000 to complete the capital stack. That's when you come to us. We look at your business plan. If it meets Denver's economic development objectives and goals and gets approved by our LRC, then we do it. The other program that we have is the Neighborhood Business Revitalization Loan Program. That loan program, you have to be located, your business has to be located in one of 8 what we call target neighborhoods. Sun Valley, Montbello, Elyria, Swansea, Globeville are a couple of the neighborhoods. If your business is located in those neighborhoods, we can do up to 50% of your total project cost, or again, whatever your demonstrated gap is, whichever is less. All we do is term loans. We don't have any lines of credit or anything like that. So the program has pretty much stayed the same since I came here in 1991.
Thank you. How about for the rest of the panelists? I'm sorry, we'll get to your story a little bit more on FattE-Bikes, but could you share any other, for anyone on the panel, changes in the funding opportunities that you have seen in your time?
Yeah, I mean, there's probably 30 different ways to skin the cat, right? I can do a loan with Rick through the OED, where he comes behind our bank as additional debt to fill up a capital stack. So there's various different ways. There's SBA funding, which is as little as 10% down, sometimes 15 or 20, depending on certain circumstances, collateral, things like that. But it's really just, figuring out the network, finding people who can add value and helping uncover various sources. And, that's Rick has always been a good partner for us over the years. And I think likewise. It's just come together with a really good business plan.
No. How about you? No. Changes in funding that you have seen? Funding. Mm-hmm.
In terms of size
or just in general, like in your time in investing, have you seen any, and I think COVID's a really good example of like, what are you seeing in trends in that as well?
Sure.
Yeah.
A couple changes. I think COVID, to your point, has particularly accelerated it. One is just funding sizes have grown immensely and valuations. I remember as a Kickstart team, we looked at, what was our average check size and average valuation at which we invested over, 2019, 20 and year to date in 2021. And it's like doubled every time we look at it. And it's crazy to see how that's the case. And, this is occurring for everyone. And we're just, if if the business model is right and we really believe in the founder, then, we're writing those checks to meet the founder where he or she is at as well. So that's been a crazy thing and is probably unsustainable. And that's a whole nother conversation. The other thing, I don't know if this is what you're referring to, but like we've seen a lot of business models that have arisen or product categories as a result of the pandemic where, the business perhaps existed pre-COVID and they experienced a major tailwind that, has accelerated their business model and, ARR, however you want to look at it. And then some businesses, the product category could not have existed and the inception occurred during COVID. So it's been a combination of things, but I think it's created a lot of opportunity and good, good times for certain segments of folks.
Yeah. So Victoria, I want to spend some time on, this is Startup Week. And so really getting your kind of insights on your journey, things that you may or may not have done differently. How do others in the room and on Zoom, follow in your footsteps? Kind of share lessons learned or advice that you would give to other entrepreneurs.
Thanks. I don't know about following in our footsteps, but it's been an interesting road. And like I said at the beginning, patience is probably your number one key to all of this because there's a lot of avenues and I think we've explored a majority of them, whether it's been accelerators, whether it's been lenders of different stripes, or even investors. It's all kind of a crazy, you kind of just, when you're starting out, you're trying everything and it's almost its own full-time job. And so I'd say, always know that when you're going after whatever amount of money you think you need, just know that you're probably almost in no case, it's rare that you're going to get the full amount from one lender. So just be prepared for being told that you're probably not going to get the full amount. And so you're going to have to keep looking if you really feel, or what is it that you really think you need versus what you wish you could have. So really being clear on what you're looking for and how much and what you're willing to give up. Again, are you willing to give up shares? How much interest with the interest rate? I've seen interest rates as low as 2%, as high as 55% or higher. So there's some crazy stuff out there. So really navigating all of that is really the key and really informing. And then also thinking outside the box. You mentioned women owned or minority owned, but there's other loans out there like for specific industries. The state and the city and whatever areas you're in, I'll always have some interesting, I don't know if they're hidden, but they're not well known. There's always these random grants or loans that I was finding when I was doing research. And so just think outside the box because there's all types of stuff out there that you'd never think of. So if you're having a hard time finding the traditional route, just keep looking. Like I said, with the city of Denver, that wasn't really on my radar. And then somehow I discovered it and it was really an awesome thing. So, but our story is just, like I said, we've had to bootstrap it a lot of the way and really get traction. And the irony is, right, once you get traction, once you start selling, all of a sudden everybody's like, yeah, you're kind of, like, I want to give you money. I'm like, yeah, but I needed you. Where were you the first year, when I really needed you? But as you grow, you're going to continue to have to stay on this path of finding the right partners and the right lenders for yourself. And it's never really goes away. I thought, by the 5th year, we'd be fine. We don't need all that money. No, it's a continual thing. And you have to continue to make those relationships. So
can you speak a little specifically to also like how you are, just as the panel has talked about how they're looking at funding and what attributes and characteristics, how did you decide? Was it kind of anything that came your way? What was the research process like? Right. And how did you make decisions about what you are willing to give up?
Well, that's an interesting question. Something that we've kind of ebbed and flowed with is how much, are we a company that has an exit strategy or not an exit strategy? We're a little bit of a different company. We're not a tech company per se, although we're an electric bike company. We're not in the tech world. We're kind of more in the manufacturing world. And so the investor strategy at the first, we kind of thought that's the route we wanted to take. And then as we kind of were starting to go through that process, we realized we're not sure if this is really what we want to give up, that amount of decision-making in our company. So we kind of switched down to the lending route and started really looking at that more heavily so that we could maintain control of our company. I would say with the loans themselves, I think at first, yes, it was a little bit of desperation. We'll take whatever we can get, but obviously they weren't the best terms except for the city. The city was amazing. So as we've matured, I think we're able to kind of more pick and choose what we're willing to commit to in terms of debt that we take on.
And I'd love to go back to the whole panel for this, but everyone kind of spoke to the right business plan. And I think oftentimes, that emerges and changes over time. So in developing that business plan and kind of pivoting and figuring out that sweet spot for yourself, like what was the key component that you felt like was asked upon often, or what insights on the business plan aspect when you're seeking funding would you highlight?
I would say the biggest thing that a lot of them want to see is really that you understand who your market is, your target market. That's a big one. And they want to see that you're actually bringing money in. Obviously, that's a big one in that, your debt to income ratio is not horrible, that you can actually make money at what you're selling, that you can show that it's profitable, and really being able to tell your story and explain why you think this is going to be the next big thing. And really also, it's also about timing, because it's got to be an industry. We got lucky. The electric bike world is exploding, right? The micro mobility world is exploding right now. So we were kind of in that startup area of when that was just taking off. So we kind of got lucky there as well. So sometimes it's about the timing of where you're at, and they're going to look at that as well. So.
Would you like to expand? No, nothing. I'd love for people to expand, especially on that timing piece, because we always hear that right time, right place. But what if you're not in the right time, right place? What would your advice be?
I think the great thing about the Denver and Colorado entrepreneur community is everyone is very supportive. It's always amazes me that I think that Josh might have a customer that can't get a loan, and he's not going to say no and let that person walk out the door. He's going to connect them to possibly me or another CDFI. If someone's coming to me and their business plan isn't really ready to go, or they're not understanding their model, then I'm going to refer them to possibly co-starters or the Small Business Development Center. It's just this amazing ecosystem and network of support for entrepreneurs and small businesses in Colorado. So I love that about this area, and what I do is that it's maybe not right. Maybe I can't help you and fund your business right now, but let's work with them. Why don't you go through one of the programs so you can really understand? Maybe you're not ready for a brick and mortar restaurant. Have you considered a food truck, or scaling and different phases of funding? So I just think it's always that kind of taking their hand and working them through and giving them the resources that are out there. She mentioned about the grant programs that are sort of hidden. OEDIT, the state of Colorado, has this really wonderful Excel spreadsheet, I think, or it's a Google Doc, and it's updated often. And it started during COVID, and it was whatever was out there. I mean, it could be, you could have had the most, niche industry and for a certain amount, and it went up there on a site. It said, Google or Facebook's having this grant, or this opportunity's there. So I would say connect with that website. And there's always opportunities, and those were grants and loans for anything. So just, if you're in Colorado, you're already starting off right.
Would you add on, or you're good? Would you like to check?
I think there are a few things you can do. If the question is like, what if the time's not right now to fundraise? I think one is seek feedback. It's really amazing to me how many founders I'm surprised by, where I have to turn them down. And I'm like, this is not the right time for us to invest for, and I typically say in my emails, if I am turning down the founder, hey, I would be happy to hop on a call and discuss feedback. And I truly mean that when I say it. And some founders take me up on that, and we have a call, and that leads to me connecting them with other VCs or, debt facilities. And it turns into a great conversation. I've had people I've turned down where they've actually, sent me deals, ironically. And that relationship and ecosystem is so important. It really is a small world that we live in, especially in the entrepreneurial ecosystem. So you always want to keep in touch and just don't sever relationships. And the second is, let's say, you know, Kickstart or whoever it is turns you down. Something I really love to see is, on top of that, staying in touch, is people saying, well, let me add you to my, you know, investor list so that, you know, we can keep in touch. And some companies, I'll get updates from them just saying, hey, this is where we're at. You know, it'll be like monthly or quarterly updates on this is where we're at in terms of revenue, or here are some milestones that we've made. And that way it gives me the opportunity to know too, like, hey, actually, this is the right time for us to invest, because now they've proven exactly, you know, my hypothesis on what needs to be true in order for us to feel comfortable to make an investment. And that's just a great, you know, easy way to just keep that relationship going in a relatively passive way. And there's some folks too where, you know, to Stefanie's point, they're willing to introduce you to other folks in the ecosystem and you should leverage those relationships. And again, I know I'm beating a dead horse by saying this, but like every relationship, you never know where it's going to lead to. So just, you know, keep attending stuff like this. Always ask people, who else should I be talking with? And you never know where that's going to lead to.
Thank you. Can you all speak a little bit too, also to that introduction? Like, how do you introduce yourself? And maybe you can speak a little bit to your own experience of introducing yourself to funders and getting in the door. And, you know, we've talked a little bit right now about keeping those relationships going, but how does one get their foot in the door?
Networking and coming to events like this. Definitely is kind of what I would go to Denver Startup Week every year from the, you know, since we first started the company. And it's really about just getting out there and meeting people and really just trying, who do you know? And if you can't help me, people are always happy to refer you on to the next person. And you just have to knock on as many doors as you can, and just keep doing that. So I would say that's how we did it. So.
Anything to add?
Yeah, no, I mean, I echo everything everybody said here, you know, from a bank side, if we can't do it, you know, we try to, you know, educate people on, you know, what we're looking for, how we can do it. I mean, there's been, the largest deal I've ever funded fully startup is over 10 million in dollars. So pretty big swing, and that's just through an educational process and also finding, you know, we're in the debt space, you know, so I know who else to kind of look at and who it might be a good opportunity for. So.
I mean, we've heard a lot about your story of startup, but I would love to hear just some examples of funding, examples that you can share that might inspire other startups, where, you know, perhaps you saw them at first blush and you didn't think that it was a viable entity, and sort of the success story of working with them. Okay.
When I first started with CEF, I work a lot with the banking community. So not only the city and the small business development centers, but we want the banks to know what we're doing and who we are. That way, because a lot of the small business owners, where they're having their regular personal banking, that's their first stop for funding. So when they can't say no, can't say yes, then they're going to call me. So one relationship I had in particular at Bank of America sent me a business owner, and he was a fashion designer. And I loved his story. He was actually looking for a very small amount of money, $10,000. His name's Dwayne Topping. And what's interesting about him is he's a Iraq war veteran. And when he came home, he had PTSD. He went into a very dark depression. And one of the things that helped him out of it, his wife gave him a sewing machine. So he taught himself how to sew, and just started creating designs, and very inclusive designs for women of all shapes and sizes, and started selling these pieces. So he was coming to us for a little bit of funding for his website, for some supplies. And the ironic part of it is we have a veteran loan program at CEF that is funded by Bank of America. So they use their CRA dollars to give back to us. So we're able to offer these veteran loans. Well, Bank of America got wind of what we were doing, and they actually featured him in a nationwide commercial. We went to his local, he's in the Denver Fashion Week, and we're actually just closed a second phase with Dwayne and giving him a little bit more, and he's been invited to New York Fashion Week. So it's just great to see his success, and like those my interactions with my clients and these business owners. I mean, I have the best job. I love it. I get to, it's like blood, sweat, and tears, right? It's not always happy. It takes a long time, it's grueling, but when you get to the end of the day, when you get to the closing, and when we can support these owners and what they're doing, and for us too, because we have that coaching piece, that we're not just, here's your money, good luck, let us know how it goes. We're here, and that they have access to that for the life of the loan. They can, whether it's finances, marketing, operations, maybe they're growing and they're like, how do I do this? This coach can get with them, and we're really there to walk alongside their journey. And then at the end of that journey, our goal is to get them back to Bank of America, back to Josh, so they can get that, bank loan that has the great terms. We are a very fair and flexible lender. We're definitely better than going to a credit card or some hard money, but the bank is, kind of the prime place to be. So.
Surely you have some stories.
I have a lot of deals. I'm going to pick out two. One was a project that we did over at about 20th and Arapahoe called Fish Hostel. Young man by the name of Chad Fish had traveled Europe, stayed in a bunch of hostels, and came back home and said, I want to do an upscale hostel, not only for college kids, but older travelers. And that deal was incredibly tough to do. We turned it down once, and he came back. I had to do a lot of selling on my part to my loan review committee, but we ultimately got it done. And it is one of the greatest little small businesses. It's really grown. Their occupancy is at about 95%. They're always filled, and it's a great project. I'm proud to have had a hand in it. The other project I worked with Josh actually at Collegiate Peaks Bank to do a project called Nurture Denver, which is this kind of community health, beauty, and I don't know what else we call it, but this is an example of where we worked with Collegiate Peaks Bank. They did probably 2 million or so of that project, maybe more, and we came in and we did about 400,000 of that project, and that was because the borrower had exhausted all of his personal funds, and the project cost more than you thought it was going to cost, and he came to us and we worked with Josh and got that project done. Beautiful project over at 29th and Federal called Nurture Denver.
Anyone else want to share?
Yeah, I mean, we've got success stories from people, that were in restaurant management, worked in restaurants all through their life. I mean, I've got one guy, he started out, he owned his first landscaping company when he was 13. He bought it for $15,000 on a seller carry. He had 2 employees while he was going through 8th and 9th grade, and his mom helped him run it. And, we've helped, we weren't in that stage, but once he got to a level that was bankable, I mean, now he's over $20 million a year in revenue. I mean, operating in, Denver, Colorado Springs, Vail Valley. And so the opportunities are endless. And so even if you're looking at existing opportunities, I always, even if sometimes there's some seller carry debt and things like that can be incorporated if there's existing business and whatnot too, that's a good option to think of as well.
I just want to add, I don't want to forget Stefanie, CEF. They helped us on the Fish Hostel project. So I want to give CEF the credit due them.
Wonderful, thank you. So any other stories that you want to share on the panel? Otherwise, we can turn it to questions from the audience or the chat.
I'm just going to put a plug out there. We have a podcast called Perfect Pitch that Karen Zelnick hosts, and Kurt Roberts, who I took the place of at Kickstart on this panel, is often on it, and they share the most amazing stories from our portfolio. I think one of them, I can't remember if I'm just familiar with the story, if it was an episode. I'm pretty sure it's an episode, but Sondermine here in Colorado started out basically as a services business. And Kurt, when he first saw that with Mark, basically said, you've got to convert this business model for us to feel comfortable investing in it. And he had to go through that whole hassle. And I believe the podcast goes through that story. So tons of stories like that, events, a bunch of others. So would encourage you to dig into that podcast. It has plenty of stories that I'm sure many of you can empathize with.
Thank you. It's a great resource. So if you,
It's kind of a two-part question to Victoria and Serene. I was curious, in your bootstrap kind of funding portion, what benefit or what did you offer back to your friends and family in terms of them providing you initial funds? And then for Serene on the venture capital side, how does a founder start to evaluate, like, okay, if I'm willing to give up ownership, how do I understand what that equation looks like if I'm willing to give up this percentage versus what I'm getting back in return?
Well, like I mentioned, the first person that came in with us, it was our business partner, and then he kind of exited and asked that the money that he had put in turned into a loan. But for others, friends and family that we approached, it was, a share in the company. Also, because we're an e-bike company, we can also pay in e-bikes if anybody's interested. So that was another kind of attractive thing, is we would pay in e-bikes as well. So basically it was mostly just, hey, you have a share in the company now. Later on, we did do a couple personal loans from people as well.
That question you're asking about how much should I feel comfortable giving up of my company is a question that you'll ask yourself at every stage fundraise, whether it's a seed, Series A, Series B. Hopefully you get to that stage of growth. And a way I can answer this is truly empathizing through my husband, who's actually a founder. And he's now gotten to the Series A point. But I remember when he was first fundraising, I was like, oh, do we feel comfortable giving up this much of the company? And, the VC that he raised from, including from Kickstart, this was like before I joined Kickstart, it was a minority investment, but you still feel this like pain of like, oh, it's like, when you equate it to however millions of dollars on paper. And at the end of the day, my husband was like, the goal for me, it depends on what you're trying to prioritize, but he's like, my priority is accelerating growth. And we can't, like right now, the market that I'm in, it's a land grab. And if I want to be part of that, I have to give up this, 10% of my company. And that's just what I'm prioritizing. For some people, it's like, I can, slowly build this over a decade. And I've worked with folks who've bootstrapped for, a dozen years before they finally took growth stage financing. And that's just worked for them by nature of, the product that they're building, the industry that they're in, and that's okay. So at the end of the day, it's really just a prioritization question. But if your priority really is to accelerate growth, to go to market as fast as possible, then the answer tends to be raise venture capital.
I think one thing we were told early on is, there's no point owning 100% of a company worth $0 versus owning 50% of a company worth $1 million, let's just say. So keeping that in the back of your brain, our situation was a little different in that our goal wasn't necessarily to exit or accelerated growth, as you put it. So we've kind of gone back and forth with that idea, but at the end of the day, you got to take what you got to take to get going, get off the ground, no matter what.
That was a great way to put it, what Victoria just said. So I'm going to echo that. I think the three things too that I would consider on why VC versus debt, and there's no right answer. It just totally depends on your business. And I'm not familiar with what your model is, but in terms of why VC and why should I be willing to give up shares on top of what I said, tends to come down to three things. One is guidance. So hopefully you work with someone on your board or investor who has been a former operator or who has seen tons of companies very similar to yours, who can provide a lot of great advice. The second tends to be network. So Kickstart, for instance, has a collective program that Karen oversees, and that's just all of our portfolio companies that we bring together, try to cross-pollinate ideas, try to connect you with folks in the portfolio who have gone through what you have. Again, another way of providing advice, but through someone who's even closer to you. And the third tends to be signal. And what I mean by that is some folks try to raise solely through angels via an SPV, and there's nothing wrong with that. But something to consider when you're raising a fundraise is if you're raising through angels solely, it's not necessarily the greatest signal for your next stage of the fundraise, where to the Series A or B funder, you typically want to show that Kickstart or whoever it is who did my Series A is willing to write a check as a follow-on into the next fundraise, showing that they have conviction into your business. And if you don't have an investment vehicle who can do that, it tends to be more difficult to fundraise. And so you don't have to have that kind of a signal, but it's definitely helpful. Will save you time.
Anyone else have a question? Or any in the chat?
You're welcome. Thank you all so much for sharing. This has been a great discussion. So you mentioned a little bit earlier on that when you're evaluating investments, you're looking for people on the team that have experience in industry. I was wondering if there's any other qualities of management that you're looking for.
Who wants to field? I'll let you. Here.
So earlier on in the discussion, you guys were talking about how when you're evaluating investments that you're looking at business plan as well as key members of management and some of their experience in industry. But I was wondering if there's any other qualities in them that you're looking for that would make them a better investment than other people. Because I mean, it's important the people in the project, right? So.
Yeah, I'll probably start since I get a mic. Really, when I'm looking at spreadsheets, like some financial acumen on that they understand the business,